Hello, good evening, students. Today we'll discuss the fourth chapter of the strategic financial management, that is security valuation. Okay, so fourth chapter of the strategic financial management, CA Finance Syllabus, security valuation. Chapter 4, security valuation, security valuation, security valuation. Okay, so before going for security valuation, first of all, we'll understand the fundamental principle behind valuation. Fundamental principle behind valuation. Whether it is a security or any asset, what is the fundamental principle behind valuation? So irrespective of the asset we are following, irrespective of the asset we are valuing, the fundamental principle is same. Chapter 4, security valuation. Chapter 4, security valuation. Okay, right. So irrespective of the asset, the fundamental principle of valuation is same. The fundamental principle of valuation is same. Valuation is same. That is, the fundamental principle of valuation is value of an asset. Value of an asset is the discounted value of expected future cash flow, expected future inflows, discounted value of expected future inflows. So this is the principle underlying the valuation. For any asset, this fundamental principle applies to any asset, whether it is a financial asset like shares or bonds, whether it is a financial asset like shares or bonds, or whether it is a real asset like building, or whether it is a physical asset, or whether it is a commodities, or whether it is a commodities, or real assets. Or real assets like land or building, or real assets like land or building, Okay, so any asset we are valuing the same. Any asset, the fundamental principle will not change. Maybe the formula you have applied may be changed, and the way you have computed is may change. Okay, but the approach is same. But the principle is same. Value of any asset is the discounted value of expected future cash inflows. Discounted value of expected future cash inflows. If I invest in shares, my future inflows may be dividend. If I invest in debentures, if I invest in my debentures, my cash flows will be interest. If I invest in debentures, my cash flows will be interest. If I invest in debentures, my cash flows will be interest. My cash flows will be interest amount. If I invest in building, my cash flows will be rental income. If I invest in building, my cash flows will be rental income. Emma, for any asset, will get some kind of inflow, some inflow or the other will get. So therefore, the principle is same. Value of an asset is the discounted value of expected future cash inflows. Okay, right? That is one. So here we are using 2 points. Inflows, future inflows is the one area to be completed, future inflows, and the another area is the discounted value. Discounted value is the second point. So if you discount the future cash flows with the required rate of return, we will get the discounted value. Okay, right. So this is about the valuation. In general. Need not be particular to the shares. Okay, this is in general. But our present chapter concerned about not with the valuation, but security valuation. It is very narrow. It is very narrow. The scope of our chapter is very narrow, but the valuation exercise is very wide. Okay, we are focusing only on the securities. Okay, Right. Next. So securities, there are many types of securities. If you look at the definition of security as given in the Securities Contract Regulation Act, there are many different types of security. But for my purpose, I am classifying securities only into 2 parts, broadly into 2 parts. Securities broadly are classified into 2 parts. One is equity, another one is debt. One is equity, another one is debt. You can take preference shares also as a debt because it is popularly called as quasi-debt. Preference shares are popularly called as quasi-debt because of more similarities between preference shares and debentures. Preference shares are sometimes treated as a part of the debt because quasi-debt. So this is equity valuation. So within the security, now we'll focus on the equity valuation. There are different methods are there, different methods of valuing the equity. Sir, why the different methods are there? Based on the different perception. What is your inflow? What is your inflow? What is your inflow? So based on your perception of inflow, the valuation method will change. The valuation method will change. It's based upon your perception, your requirements. Okay, right. First, I'll use dividend based. I'll use asset based valuation. Most traditional and conservative method of valuing the business. Asset based valuation. Asset based valuation. Asset based valuation. And the next point is dividend based valuation. Next point is dividend based valuation. Dividend based valuation. And this point is earnings based valuation. Earnings based valuation. Earnings based valuation. And the third point is cash flow based valuation. Cash flow based valuation. Cash flow based valuation. Sir, why, sir, these so many methods? Why can't we apply one method? Yes, we can't apply one method because the circumstances of the business will be different. Okay, we can't compare oranges with apples. We can't employ the same business principle for all. There is a saying in management which goes like this: one size does not fit all. One size does not fit all. One size does not fit all. So therefore, we can't come out with a single method of valuation. Single method of valuation will not fit for all the requirements of all the types of investors or all the types of business entities. So therefore, based on the circumstances, we have to use different methods of valuation. Okay, right. So then, if that is the case, so you said right. Okay, one method of valuation may not be appropriate. Different methods of valuation will be there. Then how should we choose which method of valuation should be adopted? In our academics, we are using multiple methods, but in our real life scenario, if one client comes or one investor comes to asking me to value the shares of a company, which method I use? Which method should I use? Which method should I use? So the criteria for selection of a method, the criteria for selection of a method. Now look at this point. Criteria for selection of an appropriate method of dividend valuation depends on, okay, criteria for selection of appropriate method of dividend valuation. Criteria are aspects to be considered. I should say aspects to be considered. Aspects to be considered. Aspects to be considered for determination of appropriate valuation method. For determination of appropriate valuation method. For determination of appropriate valuation method. Okay, aspects to be considered for determination of appropriate valuation method. For determination of appropriate valuation method. What are the aspects to be considered? Okay, great. We'll discuss the aspects. Next, first point. First point is nature of the company's business. Nature of the entity's business. Nature of the entity's business. It depends upon the business of the company. We have to select the valuation. We have to select the valuation. We have to select the appropriate valuation based method. What is the driver of their income? What is the driver of their income? Okay, what drives the income of a software company? What drives the income of a software company? The income of a software company is primarily driven by the employee skills. Employee skills. Because it's a skill-based sector. Because it's a skill-based sector. What is the driver of an income of an L&T company like an L&T, which is involved in infrastructure, equipment, physical assets or equipment. So their driver for a manufacturing entity, the driver of their income is the sophisticated equipment they have used. For a software company, the driver of the income is their skillful employees. So therefore, if I cannot use the asset-based valuation to a software company, not appropriate. Asset-based valuation is not appropriate for a software company. Why it is not appropriate? Their driver of the earnings is not reflected in the balance sheet. Their driver of the earnings is not reflected in the balance sheet. This method. That is asset-based valuation is readily available. We don't need to do separate exercise for that because for the sake of accounting, we might have already prepared a balance sheet. Okay, so therefore this asset-based valuation is readily available. This asset-based valuation is readily available and a simple exercise. These are all involves a lot of complicated exercises because these are all based on future. These are all based on future predictions. These are all based on future predictions, and this is based on present position. So therefore, compared to asset-based valuation, these three methods of valuation are complicated. Okay, right. I'll give you a simple logic to remember these methods of valuation. Balance sheet, asset-based valuation comes from the balance sheet. Dividend-based valuation comes from the profit and loss appropriation account. Profit and loss appropriation account. Earnings-based valuation comes from the profit and loss account. Comes from the profit and loss account. And cash flow-based valuation comes from the cash flow statement. Cash flow statement. It comes from the cash flow statement. So this is what the point. Okay, balance sheet, profit and loss appropriation account, profit and loss account, and cash flow statement. So based on different financial statements, we are using the different valuation methods. So therefore, asset-based valuation is readily available because the present position, whereas dividend-based and earnings-based is or cash flow-based is a future prediction. Is a future prediction more complicated. Sir, if it is more complicated and if it is readily available, why can't we use that? The reason I said it may not be appropriate for all the business entities. For a software entity, the driver of their income is an employee skill, which is not reflected in their balance sheet. For that matter, not only for the software company, asset-based valuation may not be appropriate for any type of industry. It can be the safest method or conservative method or less risky method, but not the optimum method. What is the conservative and what is the optimum? Conservative means no risk, no loss. Optimum means not only no risk, but also high return is there. It is not that it is not sufficient if you avoid the losses. It is required you have to earn the income. It is not sufficient if you don't have bad habits to grow. In addition to avoiding bad habits, you should have good habits to grow also. As simple as that. So therefore, here the point is that asset-based valuation is a conservative-based valuation. It has least demerits or least drawbacks. It is very less risky. At the same time, it is very less advantage also. It is not an optimum method. Why it is not an optimum method? For any business entity. I discussed a software entity as an example, but generally speaking, asset-based valuation may not be appropriate for any type of business. Why it is not appropriate? It may be conservative but not optimum. It may be conservative, good, but not sufficient. Why it is not sufficient? Sir, it is good, but is not sufficient. Why it is not sufficient? The reason is the core element of any business, the core driver of any business is their systems, is the business system, not the assets we are seeing in the balance sheet. The difference between one business and another business is their business system. Invisible business system. Sir, why you are calling it as an invisible business system? Because this invisible business system talks about the interrelation between the elements of the business. Sir, what are the interrelated elements of the business? Employees, suppliers, customers, lenders. The relationship of the company with these. Is what the drives. The connection between all the three will drive the business. Unless until we have a proper relation with the supplier, they can't deliver the goods on time. Unless until you have a proper relationship with the customer, they will not try our new product. They will not purchase the goods on cash and carry basis. Unless until they have a more employees with high morals, we cannot expect more productivity. So this will not be reflected in our balance sheet. The relationship between the employer and the employee, how the employees are feeling about the employer, or what is the employee's skill, all this will not be reflected in the balance sheet. What is the relationship with our supplier? What is the relationship with our customer? What is the relationship with our lender? All these relationships is what that drives the business. Which is apparently not reflected in the balance sheet of the company. That is the core element. If my competitor takes one business premises on rental basis, and I also can take the same business premises on rental basis, it is not, we both can't expect the same rate of return. It depends upon he also employed a qualified CA and I also employed a qualified CA, or he also employed an engineer from IIT, or I also employed an IIT from engineer. It is not sufficient. It depends upon his skill and my skill, and depends upon how he treats with the employee and how I treats with the employee. The relationships, invisible system, the relationships will not be captured in your accounting balance sheet. So therefore, this asset-based valuation is not correct. Though it is less risky, though it is good, but it is not optimum. Okay, it is the seller's disadvantage. A seller cannot sell his business based on the asset-based valuation. For a buyer, it may be good, but for a seller, it may not be good. Okay. This is what the point. So asset-based valuation is more conservative, but at the same time it is not optimal. It is not optimal. Okay. So for any business, the invisible business system is not getting reflected in the balance sheet. That is one point. Next, dividend-based valuation. Dividend-based valuation. Okay, so therefore depends upon the nature of the business, we have nature of the entity's business. For an entity like a software company, employee skill is not getting. This I said, for any business, asset-based model may not be appropriate. It may not be appropriate. It may not be appropriate, but comparatively, relatively, it may be more appropriate for a banking business, but not for a software business. So relatively, I am saying asset-based valuation is more appropriate. More means compared to software industry. For a banking sector, asset-based valuation is good. Compared to software industry, on a relative basis, it is good, but not on an absolute basis. On a relative basis, it is good, but not on an absolute basis. If you forgot about the software industry, if you take only banking sector on an absolute basis, it may not be good because their systems, business systems is not getting reflected. But compared to software industry, it is better. Because the bank's major driver of income is loans, which are reflected in the balance sheet. Or for an L&T company or an infrastructure company, this is banks and this is software, or an infrastructure company. Okay, or an infrastructure company. Banks, the primary asset is loan, or an infrastructure company or a manufacturing entity. Their asset is physical assets, machinery and equipment, reflected in balance sheet. And the employees' skill. Sorry, for a software industry. Okay, the key driver of their earnings is the employees' skill, not reflected in the balance sheet. Okay, so therefore it may not be appropriate method. So it depends upon the nature of the business. We have to select which method is appropriate. But for any business, go for the asset-based valuation. If you are a seller, if you are a buyer, asset-based valuation is the first thing you have to take. So if you are the buyer of a business, asset-based valuation is your first priority because you will get the business at less cost and with less risk. While I am purchasing, I should look for less cost and less risk. While I am selling, I should look for higher price. So therefore, if you are a purchaser, if you are an amalgamated company, or if you are an acquirer, then asset-based valuation is the best method. If you are a seller, amalgamating company or a target company, then asset-based valuation is not the good method. Depends upon the which position you are. So therefore, I should write the second element: nature of the entity's business and the size of the side of the position, and the side of the position in the position in the deal, and our position in the deal. Position in the deal. That means whether you are on seller side or buyer side. For a seller point of view, asset-based valuation is not good because his true worth is not getting reflected. For a buyer, it is good. So therefore, amalgamated company may be willing to use the asset-based valuation, but amalgamating company may not be willing to sell their business based on asset-based valuation. That is what the point. Next. So position in the deal, and the next point is stage of the business, stage of the development. Look at this point. So if you are in the initial stages, you are not even earning any net profit. If you are in the initial stages, you are not even earning any net profits, then cash flow based valuation may be correct. Maybe possible. I'm not saying that it is correct. What I am saying is it is possible because I have not even started generating the earnings. Like a startup companies, they have not even started earnings. In that case, there is no earnings. If there is no earnings, obviously the dividend will not be there. So therefore, cash flow based valuation may be appropriate for a startup entity. Cash flow based model may be appropriate. For a developing business, that means which has started earnings but has not yet developed. developing, which is in the process of development, but it is not yet developed. In that business, even though they are earning profits, but they will not declare any dividend, because whatever the earnings, they will utilize for reinvestment in the business. They will utilize for reinvestment in the business. So therefore, they may not invest. They may not pay dividend. So therefore, this is not possible. This is not possible. For the developing entity, earnings are there, but the earnings are not distributed. Dividend is not there. Dividend is not there. So therefore, this method may not be possible. Okay, this method may not be possible for a developing entity. But for a matured entity, which does not have any future business investment opportunities, which does not have further reinvestment opportunities, they can use this dividend-based valuation. Which does not have reinvestment opportunities, they can use this dividend-based valuation. Okay, because whatever the earnings are there, most probably entire earnings or almost all earnings, they will be paying in the form of dividend, because they don't have any investment opportunities, or if at all they have, they will be having less investment opportunities. So therefore, for a matured entity which is consistently paying dividend and which is paying major portion of the earnings as a dividend, dividend-based value is appropriate. For whom dividend-based model is appropriate? Dividend-based model is appropriate for an entity which is in the saturation stage or matured stage, which is getting good earnings and which is paying more earnings as a dividend. Which is getting earnings and paying more earnings as a dividend. Okay, that is the case. Dividend-based valuation. So therefore, depends upon the stage of development. Depends upon the stage of development. And the last point is that different people may use different aspects. It's based on my perception. Strategic financial management, or for that matter, financial management is a customized subject, not a standardized subject like legal subjects like taxation and company law. They are standardized. This is customized subject, because the legal position will be almost same. If I am arguing or some other lawyer is arguing, the legal position will not change. The Supreme Court verdict will not change. Okay, but in case of financial management, his way of thinking may be different, and my way of thinking may be different, and his extent of perception may be different. He may be looking at some angle, I may be looking at all the angles. So therefore, it is a customized subject. It is a customized subject. We can't get one answer for the same question. For the same question, we'll get different answers in the financial management subject. That means but the reason why I have explained is that these aspects is in my own perception, is based on my understanding. If you look at the different author book, if you come out with a different aspects, don't ask me. This is perception. This is perception. You may be using less points, or you may be using more points, or you may be using different points. It is based upon his perception. It is based upon his perception. Okay, it is based upon his perception. Okay, so therefore it is a customized subject. It is to the extent which I understood the subject, not I learned from somebody else. But understand, law is like what I learned from the Bare Act. Law is like what I learned from the Bare Act. Whereas an SFM is not I have learned from somewhere which I pursued personally, which is my personal perception, not somewhere prescribed by the government. Okay, so therefore it is a customized subject. So this is based on my perception. This is based on my perception. Okay, there may be overlap, there may be contradictories also. Okay, great. Next, what is the point? Next stage of development. Next, extent of stake. Extent of stake. Extent of stake. Extent of stake. So extent of stake. So if, say, for example, if the company is earning 100 crores profits, 100 crores as profits, 100 crores as profits, and distributing only 30 crores, and distributing only 30 crores as a dividend. 30 crores as a dividend. Both A and B, both have invested in the same company. Both A and B, they have invested in the same company. But A may be preferring to use earnings-based method, but B is preferring to use dividend-based method. Why, sir? Same company, same business, same stage of development. Same company, same business, same stage of development. Then why, sir, different methods? Because the stake is different. For the A, he has invested majority stake. He holds 80% of the company shares. He holds only 5% of the company shares. Therefore, B is at the receiving end. B is at the receiving end. So for him, whatever the company declared as dividend, he has a control or right over only this 30 crores. He does not have a right over this 70 crores. He can't force the directors to pay that 70 crores as a dividend. He can't force that because he has a minority stake. So for him, for B, whatever the company declares as dividend, that much only his income. He don't have control over the earnings. He don't have control over the earnings. Okay. He don't have control over the earnings. He can't force the directors to declare more dividend. So therefore, he was conservatively, was whatever is declared by the company, that is only my income. Earnings, I don't know, because I don't have any right to force the directors to declare dividend. Whereas A has the power to force the directors to declare the 70% whenever A wants money. Whenever A wants money, A can ask the directors to declare dividend. A can ask the directors to declare dividend by using the power. Similar manner, like whenever the central government funds, central government is pushing the RBI to declare dividend. Because of the central government's control over the RBI. Central government is pushing the RBI to declare the dividend because of the control. That is the reason. So because A has a control over the company, he can ask the directors to declare the dividend whenever he wants. But if the directors refuses to declare the dividend, he can change the directors because he has a majority stake. If the directors refuses to declare the dividend, he can change the directors. Therefore, for him, entire 100 crores is his income because it is like his bank balance. For A, it is like his bank balance. Whenever he wants, he can withdraw like ATM. Whenever he wants money, he will just make a phone call to the director. I want this much of dividend. Please declare the dividend. That's it. If you don't declare the dividend, I will change it. As simple as that. That means for this 100 crores is like his bank balance. Whenever he wants, he can withdraw like how we are withdrawing money in the ATM. He has a complete control over this. Central government has a complete control over the RBI reserves. Okay, whenever the government wants, government is forcing the RBI to declare the dividend. Okay, whether it is good for the company, secondary. It is possible. What I am saying is it is possible. I'm not saying whether it is good. Sorry, is it good to blackmail the directors? I'm not talking about the good or bad. I'm talking about the possibility. Okay, so therefore, for A, earnings-based method, A will use earnings-based method, and B will use dividend-based method. That is what the point. Okay, same company, same type of business, and same stage of development, but depends upon the position. Therefore, like one size does not fit all. We can't apply the same. We can't apply the same method of valuation to all the investors. So if A is our client and B is our client, we can't copy the A's method of valuation to B. So our work depends upon our client. Like how I teaches you the strategic financial management is different from how I teaches the same topic to the CFA over level 3 students. I teach the same concept to the CFA level 3 students. That is different and this is different. Because the extent of depth in CFA is different and the extent of depth in CA is different. In CA, we are discussing only basics. But in CFA level 3, will go subject in deep. So therefore, based on my student, I have to deliver. I can't deliver the same content to all the students. So therefore, based on you are my client. Based on the client, I have to change my method by extent of teaching. In the same manner, A and B are your clients. A and B are your investor clients. So you can't apply the same methods to A and B. Depends upon their position you can apply. Okay, right. So therefore, the fourth aspect to be considered is the extent of stake. Next, one more aspect is there. So say C, I'll take one more investor C. C also invested 5% stake like A. C also, one more investor C is there. He also invested 5% stake like A. So like B, so he also invested 5% stake like B, but still you want to use earnings-based method. Why, sir? Same business, same stage of development, same extent of stake. Why, sir? Same 5%. Why he was using dividend? But why he was using earnings-based method? Because of the investment horizon. Even though this 70 crores is not declared today by the company, one day or the other that belongs to the shareholders only. Tomorrow, if the company goes for winding up, it will be given to the shareholders only. Therefore, in the long run, shareholders will get that earnings. One day or the other. Today, the company is having some investment opportunities. That is the reason company is retaining the earnings. Once the investment opportunity is completed, they will distribute that 70 crores to you only. Today or the other, maybe after 3 years, maybe after 5 years. So therefore, see with the then why, sir? Then why not? Then why B is not thinking in the long term? Because his investment horizon is less. He wants to go out of the company after 1 year. He doesn't want to stay with the company for a long period of time. He wants to go out of the company after 1 year. So therefore, if the company declares after 3 years, after 5 years, or after 10 years, he will not get that because by that time he is not there in the company. He will be there in the company only for the next year. He will be there in the company only for the next year. So therefore, he thought that, boss, the company, no doubt, I'll agree that earnings is one day or the other will come to me. The day when it will come, I will not be there in the company. I'll agree one day or the other that will come to me only, but that day I will not be there in the company. I do agree that company may be paying within 10 years, but I will not stay with the company within 10 years. I'll stay only for the next 1 year. So obviously for me that is not considered. But see, even though he invested 5%, he is a long-term investor. He's invested permanently. Till the company continues, till the company service, or 10 years. So since C is focusing on the long term, C is of the view that, sir, one day or the other that will come to me only. If the company is not declaring dividend and is accumulating reserves, obviously that will be reflected in the share price. I can sell the shares after 5 years and I'll get good amount of capital gain. So for me, earnings-based valuation is good. I'll go with earnings-based valuation. Okay, therefore, that fifth point comes is the investment horizon. Investment horizon refers to how long you want to stay with the company. Investment horizon. Emma, you have to learn the subject keeping in mind the application, where to apply, not just for the sake of learning. Okay, the purpose of learning is to apply. The purpose of whatever we are learning in our academics, under what circumstances it will be applied. That you should be aware of. Okay. So having said that, based on the according to these different methods, the appropriate method depends upon these aspects. Right. Now we'll look at the one by one method. So since academically people will start with the dividend based valuation, even the ICA also. So I'll start with the dividend based valuation. Okay. So the rest of the models we'll see later. So we'll start with the dividend based valuation. Okay. Dividend based valuation. Okay. Dividend based valuation. Okay. Dividend based valuation. Okay, ma. So this dividend based valuation, as I discussed, any asset you value, any method you use, don't forget this fundamental principle. Our formula comes from this fundamental principle. You should be able to link that formula with this fundamental principle. Okay, right. Let me check this point. Okay, dividend based valuation. What is the inflow, sir? Any valuation method, any asset, any method of valuation, any asset and any method of valuation, discounted value of future cash inflows, as simple as that. Discounted value of future inflows. Any method you use, this is what we want. Discounted value of future inflows. Okay, discounted value of future inflows. Right. Now we look at this point. Discounted value of future inflows. What is the inflow, sir? What should I take as an inflow? Depends upon the method you are selecting. If you have taken earnings based method, that is earnings. If you have taken a cash flow based method, that is cash flow. If you are taking a dividend based method, that is a dividend. So dividend is my earnings. Future inflows, capital A I use. Future inflows. The two elements in valuation is future inflows. What are the two inflows in future? What are the two inflows of future? One is dividend. Okay. One is dividend. Another one is sale price. So during the investment horizon, so long as I hold the shares, during the holding period, I'll get the dividend. So long as I am holding the shares, I'll get the dividend. So the moment when I sell the share, I'll get the sale price. Both are my inflows. So this is the dividend and inflow. And the next point is discounting. So how will you get the discounted value? Discounted value requires a discounted value. So we have to discount the future cash inflows with the required rate of return. Required rate of return. Okay, Emma, this is an altogether different topic. I'll discuss in the next class. Required rate of return. Popularly people will use this kind of terminology. This for the discount rate, discounted value. People will use different terminology. Say for example, somebody will use opportunity cost of capital, opportunity cost of capital, opportunity cost of capital, and somebody will use required rate of return, required rate of return, required rate of return, required rate of return, and expected rate of return. These are the different terminologies used. Expected rate of return, these are the different terminologies used. But according to my person, as I said, this subject is customized. This subject is a customized. Different people will have a different opinion on this. So this is the popular words. Okay, this is what is popularly used in the market. This is what is popularly used in the market. But according to me, I'll not use none of this. Okay, the terminology which I would like to use is entitled rate of return. Entitled rate of return. Entitled rate of return. You may use the same symbol. Popularly we use KE, cost of equity. They might have earned in your CA Inter, cost of equity, KE. I'll also use the same. But the description which I have given, the expression symbolically, I have expressed the KE only. But the description which I use is entitled rate of return. The way I pursue this concept is entitled rate of return. Why like that? I'll explain the next class. Okay? Why I don't want to use this opportunity cost of capital, required rate of return, or expected rate of return. Why I would like to use entitled rate of return. That I'll discuss in the next class. But anyway, the formula based on the same KE is the one. Okay, these are the 2 points. So therefore, if that is the case, value of any asset or price of any asset. Therefore here also we should understand, even though our chapter is security valuation, what we are doing is a valuation. What we are doing is a valuation. There is a difference between value and price. There is a difference between value and price. So be clear, value and price. There is a difference between value and price. Okay, as one of the Warren Buffett's advisor, not the Warren Buffett, Warren Buffett's teacher. Okay, who taught investment to Warren Buffett. Okay, they said value is what we pay. Value is what we pay. Normally, people are thinking that it is what said by Warren Buffett. No, it is the advice given by his advisor to the Warren Buffett. Value is what we get. Value is what we get. Price is what we pay. Price is what we pay. Value is what we get. The price is what we pay. Okay, so this is what we get. So therefore, normally value is different and price is different. Both are contradictory. Value is what we get, which is about inflows, our inflows, and price is what we pay. It's about outflows. It's our outflows. It's our outflows. So then, why you are equating sir inflows with outflows? If I equate inflows with outflows, I don't get any profits. So that are all I'll discuss in the next class. Okay, these are all the points you have to think. It is not sufficient if we solve 101 problems. So it is unfortunate thing that ICA is giving the same blunder problems in the exam. What is there in the practice manual? They are simply spoiling the students' knowledge skills. They are simply spoiling the curiosity by dumping the same problems in the practice manual. Students are not willing to think about it. So therefore, nowadays computation is not what we want. We want the thinking. Computers are there to compute. In an automated world, we want to think more, not calculate more. Computers are there to calculate. Therefore, think more than we calculate. Think more than calculate. Okay, ma? So therefore, these are all the points I'll discuss later. None of this knowledge is necessary to just simply get the exemption. Simply by having 600 problems in the IC practice, one of the same problems will come with some simply changing the numbers. Sometimes they don't even change the numbers also. They will change only the names. Okay, so they will change only the names are. Okay, that is the reason. So therefore, to get exemption in the SFM, you no need to come to my class. Those whose primary goal is to get exemption in the exam, just by the practice manual will get. So those who want to succeed in your professional life, for them only my class will be more appropriate. Remember, we are living in a privatized world, not a governmentized world. For a government job, certificate is important. For a private job, skill is important. For a private job, skill is important. Certificate is also important. That comes in the filtration stage. To filter, certificates are used. But after filtration, to survive, skill is required. So therefore, I'll discuss all this theory, not necessary for the exam. So if after listening my class, you'll come to realize something called as the peaks of unconsciousness prevailing in the market, the peaks of ignorance prevailing in the market, with how much blindedness people are doing these problems. In the strategic financial management, if you ask the basic questions also, students are blundering. They are able to put at doing 600 problems given in the practice manual, they got the exemption. But if you ask the basic questions, they are not. The reason is problems. Doing, calculating. Okay, without any thinking. So solving the problems without having a proper theoretical background is like directionless driving. But don't use this directionless driving. Directionless driving. Directionless driving. Where we are going, why we are going, we don't know how to go. That's it. Doing the problems is how to go. So when to use the accelerator, when to use the brake, that's it. But we are completely ignorant of in which direction you are going. If at all why you are going, this is blank. We know how to go, Sir, we know how to solve the problems. Why we are solving this problem, where we'll apply this problem, obviously no, sir. We'll get the same problems in the exam. That is what the ICA is damaging the skills or curiosity of the students. Okay, maybe we are expecting the ICA to change that perception. Okay, it throws a least impression on the industry. Industry will have least impression if you get that kind of value. If you get that kind of question papers, industry will lose the value or reputation over the CA profession. Come on, right? That's why. So therefore, these are all the points I'll discuss. While even though we are using this chapter called as a valuation, in the formula we use something called as price, but utterly it is different. Utterly it is different. But still we are equating. Why? That I'll discuss the next class. So for the time being, if I use this formula, P0 price today is equal to, remember what I said, value or price. Value or price. What I said, present value of future cash inflows. What is the future cash inflows? Dividend. Dividend at the end of 1 year. Expected dividend at the end of 1 year. And sale price at the end of 1 year. Emma, I came from the theory to the problem. I didn't go on from the formula to the problem. Theory to the problem. Theory to the formula. Theory, read the theory and correlate with the formula and then try to solve the problems. Don't directly do this point. This is the computer's task. And the human task lies in converting the theory into formula and giving that formula to the computer. That the computer will calculate. So don't train yourself to compete with the computer. Okay. So therefore, theory to formula, formula to problems. So in real life, this is done by the computers. This is done by the computers. Once you give a formula or programming, computer will take care of it. So you are preparing as if you are going to become a computer. No, in real life, your services are not required. In real life, your services of computing the values, nobody requires your service of computing the values. Everybody requires your formula. How to arrive at the formula, how to design a model, how to design a valuation model. Okay, right. Next, so having said that, so D1 divided D1 plus P1. So this is what my D1 plus P1. This stands about our future cash inflows. This is our future cash inflows. This is my future cash inflows. This is my future cash inflows. Next, I have to discount it. I have to discount it. So discount it, I am using 1 plus KE, required rate of return. I'll discuss separately about KE while discussing this concept, why you are using that as entitled rate of return. Every topic, each and every variable, I need one class, separate class one. To discuss each and every variable, I need a separate class. Don't expect everything in the same class, in the same day. Okay, so this is D1 plus P1, 1 plus P. So this is D1 plus P1. So P0 is equal to D1 plus P1 divided by 1 plus P. This is what the formula. Now, what is P1? What is P1? So what is P1? Sir, what is P1? If you ask me, sir, what is P1? No, what is P1? P1 is the expected rate of return. P1 is the expected rate of return. P1 is the expected rate of expected sale price. Expected sale price. Sir, how will you get the expected sale price? How will you get the expected sale price? Look at what is the present price. Look at what is the present price and how much it will grow. How much it will grow? 1 plus Z. If the present share price is 300 rupees, 300 rupees is the present price, and we are expecting that every year the stock price is jumping 30%. Every year the stock price is jumping 30% plus 30%. That is 90. 300 into 90. So you will get 390. Emma, how I got the 390? I got 300 into 1.3 is 390. Emma, how I got 390? How I got the expected price of 390? How I got the expected price of 390? 300 into 1.3. 300 into 1.3. How I got 1.3? 1 plus 0.3. What is that 0.3 growth rate? What is that 0.3 growth rate? This is the P1, 390. This is the 390 or P1. P1. So therefore, I can write P1 is equal to P1 is equal to P1 is equal to P0 into 1 plus growth rate. P1 is equal to P0 into 1 plus growth rate. P1 is equal to P0 into 1 plus growth rate. Okay. So now I have to rechange the formula. I have to rechange the formula. P0 is equal to D1 plus P0 into 1 plus growth rate. 1 plus growth rate. This is divided by 1 plus K. This is the formula. Now if you rearrange the formula, so if you rearrange the formula, look at this point. P0 into 1 plus K. I'll write P0 is equal to 1 plus K is equal to D1 plus P0 into 1 plus G. Now if I take P0 plus P0 K, P0 plus P0 K, okay, is equal to D1 plus P0 plus P0 G. D1 plus P0 plus P0 G. So this is what the point. Next, so if that is the case, I'll take out this point P0 plus P0 KE, I'll take this to left hand side minus P0 minus P0 G is equal to D1 Now if I cancel these two, what are the two things I have to cancel? I have to cancel this P0 and this P0. So what is this P0 and this P0 I am cancelling. This P0 and this P0 I am cancelling. Now whatever is there KE minus G, I'll take a common thing. I'll take P0 into common. I'll write KE minus G is equal to D1. So therefore P0 is equal to D1 divided by KE minus G. P0 is equal to D1 divided by KE minus G. This is what the formula. To pass the exam, this is sufficient. We no need to look at the fundamental principle of valuation. We no need to look at the aspects to be considered in valuation and which method to be applied to which circumstances. All this is not necessary. So to pass the exam and to score the exemption in the exam, this is necessary, sufficient. I can straight away start the problem with this, but not. I don't want directionless driving. Don't just drive the vehicle. Look at which direction you are going and why you are going. All these points to be looked into. Okay, this is the formula. P0 is equal to. In the next class, I think now the time is up. In the next class, we'll discuss different aspects. Why V0 and is equal to P0. Even though our chapter is valuation V0, why we are using it as a P0? Okay, why we are equating V0 is equal to P0? What we computed is P0. What we computed is price, but we are equating price with value. Why, sir? So for V0 is also the same formula, P0 is also the same formula. But theoretically, we have seen that value is what we get, price is what we pay. Utterly conflict-free. Why we are discussing? Why we are equating both? Why we are equating price with the value? That we'll discuss in the next class. And another aspect which we have to discuss is that, sir, what is this KE? KE I have seen, right? Opportunity cost of capital, required rate of return, expected rate of return. I am using entitled rate of return. Emma, this is according to my perception. Okay. Next, G, growth rate. So how the company will grow? What is the growth rate? Different methodologies of growth rate are there. So popularly in our academics, we use sustainable growth rate. So in our next class, we'll discuss these three aspects. So why we are equating price with the value, and why I would like to use entitled rate of return only, and why we are computing the growth rate in a particular manner. Okay, the formula given is the book says please read to our sustainable growth rate. Why this formula? We'll discuss some background theory, and based on that, is it possible to change this formula? Yes or no? All those things we'll discuss in the next class. That's all for the day. Thank you, ma. Good night, all of you.